All right, welcome in everybody. I'll give you guys, as always, a few seconds for YouTube to catch up to the live stream. We have a lot to cover tonight. Some exciting announcements, maybe some questions from you guys. You might have seen a pop up in our app, so we'll cover all that. We do have a little bit of a new smartfolio to briefly discuss. As always, we will also go over the market updates, some trades, which I don't think there have been many, if any, since last time we spoke in the smartfolios. And lastly, as always, we will give away an Amazon gift card for the best question that's asked tonight. So, seen some folks in the chat, assuming the audio and everything's good. So let's jump right into it. I'm going to stop the share. So a couple things. So if you guys haven't been inside of your app in a while, please do so. This may not apply to everyone, but it most likely does. The gist of it is you're going to see a pop-up inside the platform right when you log in. It's going to ask you to go through the identity verification process. Most people, just from my experience, we have 95% of the things that we need from you. But in improving security and many other things on the platform, we're having everyone go through the identity verification process again. It's a very simple process. You type in your cell phone number. It's going to send you a code. You'll take a picture of a QR code. That will be your way to upload your driver's license, and that is literally it. So please do so on that. We'll need it in the next couple weeks, and we'd hate to do it at the 11th hour. So while I get that out of the way, I want to introduce Kelly. Kelly, how's it going?
I'm still hanging in there after all these years. So it's going good.
I think that's a good thing, as you said. I'm going to do the disclaimer real quick, and then we will get into the agenda and then right into the market update. So iFlip Investor Inc. and iFlip Financial Services are not financial advisors and do not make, buy, sell, or hold recommendations on any financial instrument. This presentation is for educational purposes only. Unique experiences and past performances do not guarantee future results. All financial investments involve risk. You should speak with your CPA or financial representative to ensure the iFlip smartfolios that you select are suitable for your investment profile before trading in a live brokerage account. Whew, that's always a lot. So the agenda today, I started with the announcement. If you guys have questions on the pop-up, feel free to put them in the chat. As always, you're welcome to, let me get the email up. Send any questions into mailbag@iflipinvest.com. Be happy to help you with that there. So we're going to go over the new smartfolio a little bit. As always, I kind of already said all this, but we'll do the market update with Kelly. Some recent trades. I don't think, as I've already said, there's many in the smartfolios. And as always, the Q&A is your gateway to maybe winning an Amazon gift card tonight. So Kelly, with all that being said, I think it's your time to shine.
Okay, shine. Okay, I certainly like the adjective. Hello, everybody. Welcome again to another chapter episode of the AI Circle, where we kind of go over the markets, talk about anything new going on at iFlip, just the acronym of Flip Investor. Flip, all whatever we want to call ourselves. Generally, I'm going to start with a market update, and then we can talk a little bit about the new products that are going to be new smartfolios that will be launched at some point in the very near future. Let's start, like I always do, with the general market. The general market, we always start with the Dow, even though, as you've heard me say so many times, that this is the least important index out there, but regardless of that, that is the most followed. This is a picture of a candlestick chart of a year-to-date chart of the Dow Jones Industrial Average. I think most people would say, if I just look at this, again, believe it or not, the market seems to be going up. That's our sense of it every day. I can't tell you how many people I talk to and say, oh, the market is just on fire. It's really going up. And my response is always, is it? Because it's a different, it's very similar to Gaza versus Arizona, where I live. In Gaza, they're both places on earth, but they're completely different places. In the case of the Dow Jones, we are still only 4.5 to 6% higher on the year in the Dow. This is not really telling me of a very exploding market moving higher. And if we look back, yes, I would agree from last November when the market rally began. Yes, we have had a great rally, but most of that rally was over by the beginning of 2024. If we go to the Russell, by the way, it's the same story. The Russell is very close to being down on the year in price. That's the broader market. And as we know, the Russell represents all the stocks that the top 2,000 stocks, the Russell 2000, and it's a broader picture of the overall market, which is telling you something that, hey, wait a minute, the broader market again, I know this is starting to get old, but it's so important to reinforce, and I will make that more clear in a few minutes, that when you see a broader market that is struggling, it means that the broader economy is not enjoying what a focused part of the economy is enjoying. The technology side of this economy is obviously on fire, and we know why. We know that there's the NVIDIAs, the Mag 7 that we continue to talk about, that have just literally powered the larger indices higher, like the S&P 500. Here's a picture of that. So the S&P 500 on a year-to-date basis is up about 13%, almost 14% right now. That's a pretty good move for the first 6 months of the year. But I'm going to tell you, I don't think, folks, that this means that the last 6 months will represent the next 6 months when you look at what's going on with other things in the market. Why has the Mag 7, the Apples, here it is, the Googles on their highs, the Metas almost on their highs, the Amazons new high, Microsoft new high, Netflix almost, my God, it almost looked like Microsoft. New high, almost a new high. NVIDIA off its highs, but seemingly trying to come back. Why is this? It's because these 7 stocks that I've been pointing out, and again, old record, are what's keeping the market higher. The Dow would be down if this wasn't the case. The S&P would be down if this wasn't the case. The Russell and other things would obviously be down because they're almost down on the year now. Why? What's going on? Back to the bond story. I'm going to make this one quick, folks. As you've heard me say many, many times, the bond market is inversely related to the stock market. As the bond prices go lower, that means interest rates go higher. This world loves lower interest rates. If you remember a couple of weeks back, we had another good number that made the market think the Fed definitely now this time, for sure, will cut interest rates. No cut. I don't believe there will be a cut in 2024. I think most people actually hold that view. And if there is a cut in an election year, which is kind of unusual, it would only be one cut. In the market, of course, because of just that news, the bond market rallied a mere 2%. But the stock market, the Mag 7, say, oh my God, this is exactly what we want. OMG. So let's us rally 10%. So this is called a bifurcated market. It is not representative of what's really going on in the economy. The economy really isn't that good. And there's a lot of places we could point, and it's not a Republican-Democrat thing. It's just really not that good. And so we can get all into it, but interest rates here, again, this is just a main downward movement in price for the interest rate market. Tells me that these things are likely to go lower. Like I've said before, they keep having hope for a rally, and that's all that is a little bit up here means a lot up in the Mag 7, and that just pulls the overall market higher. Let's take a look real quick. It's very important to keep an eye on Bitcoin. So I'm going to switch over to a picture of that. Where is I'll take a look at it in terms of the Global Bitcoin Trust, because it's been around longer. As you can tell, we are struggling with the 70,000 area, or basically 65 on the EBIT. Actually, let me go straight over to the crypto market and just bring up real Bitcoin pricing. There we go. Looks the same, of course, because they're the same thing. But the market had a huge rally, as we know, to 73,000. And now this has formed a pennant. When the pennant occurs, this is just classic Edwards and McGee, if anybody's ever heard of that, technical analysis. Pennants are things that you have a flagpole, and then you have like a pennant, like a little flag is drawn after the pole has been made. And generally, when these things occur, they tend to try to break out one way or the other, generally higher if the part of the pole was higher. This market is having trouble going back up. Why? I think personally, this is just an opinion, which is, my opinion is just as valuable as most and maybe less valuable than others, is that this market has been tied to the stock market. As the stock market is doing well, obviously it encourages people to take more risk. And then they put their risk dollars into things like this, IBIT or Global Bitcoin Trust or Bitcoin directly. And when they do that, that makes the market go higher. Well, the market's kind of on its highs here, and this thing is started to fall off. Now, I'm very bullish on Bitcoin overall. I really thought it could make 100,000 by summer. We just started the summer with the summer solstice on June 21st. I think that was just late last week. And so this market here somehow is fallen lower, even though stock prices on the indices have gone higher. Why? I think the reason is because they're looking at the broader market the way I do, and the way I hope most of you do, with skepticism. There is no problem ever of taking profits. You never go broke taking a profit. However, you can never get out of the stock market all that you want if you always are buying and selling and you're not a professional at it. Well, the idea, of course, of our company and Flip, and why we all hope you are here, is to use science to guide us through all of this. What we do here on the AI Circle every week is to give ideas towards the science, but also tell you what's going on in the overall market. So overall market interest rates are steady on the 10-year note at around 4.25 to 4.3. If we start to tick higher in rates, you can look for a fallback in the stock market and maybe a little further pullback in Bitcoin. On the other hand, if interest rates stay steady and maybe trickle a little lower, you can expect the Mag 7 to continue to drag things up. And that's why we've seen such a reduction in volatility lately. It's so kind of unusual to see the market. If I bring that back this and go to the Dow, it's kind of unusual to see all of a sudden how the days are coming smaller and smaller. Like today, the Dow is only up 15 points. And we all know that any given day now, the Dow could be up 300 and the NASDAQ could be down 200. But again, going back to a bifurcated market. I've actually never saw this in my life. Never. I saw it at very small scales. But when the market is moving around 1% a day, and another index is moving down 1% in a day, I've never saw that. I've seen, NASDAQ up, 0.25%, Dow down 0.25%. That happens. But now we're seeing 1% moves on each side. And notice the price we're at nominally. We're at much higher prices. So 1% is larger movements of absolute price to make that 1% move. The market is ultimately bifurcated. And because of that, I'm going to say there is going to be a time this summer when we would probably have been happy to sell in May and go away. Right now, the portfolios are performing fine. If the market were to turn down, our portfolios would start to kick in exits, which we would hope to see. And if the market continues to go up, I don't know what that even means anymore, because where is it going to go when I'm seeing the Dow very close to going down on the year and broader markets already down on the year? So that doesn't get reported like much news these days. When you watch a financial show, you just hear about the raging market. But when you zoom in at any level of greater granularity, you'll find that all is not what it appears. I think we should all be cautious in this time, and I feel that sometime over the summer we're going to find a real problem, and it'll put the Dow down on the year, and I think it's going to do damage to the S&P and probably a few of the components of even the Mag 7. We shall see. I've covered Bitcoin, Lee. I've covered the market. The dollar, I might as well quickly look at that. I can't really say much about the dollar here. I mean, it's in a range, and really that's what most global economies want. G7 leaders want the dollar to stay in a range, and it is for the most part. However, it is very noteworthy to take a look at something else that is going on here. And I think most of you know this. Look at what's happening to the Japanese yen. The dollar is extraordinarily strong against the yen. So if anybody ever wanted to go to Tokyo and visit, now's the time. You'll never, again, this has never occurred. Why is the Japanese market so weak? I can talk to this forever. I've had many conversations over the last 30 years on this. This actually would be a fun topic to discuss with people that are very aware. It actually occurred literally in the early 90s at the Plaza Accord in New York. And that's when, at that time, if you all remember, the Japanese their currency was so strong, they were buying up most of the buildings in New York City. Those days are over. There's a lot of issues in Japan, and I won't say that population growth is negative, so their population is contracting. Their stock market, even though it's on its highs, there's a disinterest in it. Their manufacturing output is smaller relative to the amount of debt that they incurred. Why? Because their currency is literally weakened, and therefore their debt becomes higher. It takes more yen to pay back monies on their JGB, which is the Japanese government bond. There's a plethora of issues in Japan, but this is noteworthy. This is noteworthy mostly because this is a large, third largest at one time, industrial country in the world. And now, to me, when I see something like this, it looks like it's going to implode. And what consequences would that bring to the global economy should all of a sudden something worse happen in Japan? This is not sustainable for a country that is such a GDP producer. Something is going to break. There's a lot of things out there that look like they're going to break. They just are being held together, I feel, with shattered glass. This being said, I've covered the dollar now, and I've covered crypto and foreign currency. Let's go to some questions.
Yeah, well, first, let me get that away. So you talked not only about dollar and potential inflation, all of this stuff. We actually, you just built a new portfolio. I know you wanted to say a little bit about it. And before I let Kelly chime in, our marketing team has something in the works here. In the next probably week or two, you guys will get an email all about it, detailing what the portfolio is about. But Kelly's going to kind of give you some insight about it right now. And maybe why'd you create it, Kelly?
Well,
first, maybe what's it called? Sorry.
It's called Shield. We're going to have two new portfolios. One is called Shield. Let's talk about that one first. The Shield portfolio is designed to ultimately and hopefully shield us against economic impacts like inflation. Right now, we know there is inflation, but what is it really? Inflation is running around 3%. It might take a blip a little higher, but it has come down from a high of around 9%. However, the embedded inflation is still there. So when you embed inflation, in other words, the prices have already gone up. If they don't go, once, say a price, it's very important to discuss this, and I hope people recognize it. It is about the way you measure a statistic. For example, the statistics that, for example, crime is on the downfall around America. Well, it depends. The same thing is true about inflation. Inflation has come down. However, the prices from the time of COVID till now are still much higher. I would say at the grocery store, for example, the prices, you could make the argument that prices are around 30% higher. Everything from Diet Coke, eggs, sometimes bread. It just depends. If you're a savvy shopper, you can keep those things mitigated. But the bottom line is the base price is now higher. So if it inflates from here at 3% a year, in other words, something that's $10 goes up 30 cents a year, then that's okay, even though it's higher than expectations. But wait a minute, that thing that was $10 today going up at 3%, just 4 years ago, that thing might have been $6. So when you measure inflation, it is the rate of increase, but not based on the absolute current price. And so that is why an argument could be made that inflation is coming down, but people don't see that because the prices they're paying are still elevated. This was true in the 80s. In the 80s, inflation was starting to come down during the Reagan administration. However, the prices had already gone up, and it took literally a dozen years into the Bush administration and early Clinton administration for prices to finally fall back. Why? Wage price inflation. It's not just the inflation that we see when we buy a loaf of bread. It's the inflation that goes to the wages that allowed that bread to get to a shelf for you to buy it. Wage price inflation is the real battle that we face today because people want more money. They need more money to be able to pay for the same goods and services that were cheaper 4 years ago. So inflation may be coming down, but embedded price is going to remain high. And the analogy to that is the same thing when I mentioned crime. When crime rates are being said to come down, fine. But if you don't prosecute a person for a crime of stealing from, say, a convenience store anymore, and they can steal $1,000 worth of merchandise, and you don't prosecute them, no crime has occurred. Before you would have counted that. Now we don't. So now you can say, yeah, crime is going down. It's because we're not prosecuting it. Very similar to inflation. That's very noteworthy.
What an analogy. So with all that being said, the
Shield portfolio, let me finish a little more on that. The Shield portfolio is designed to manage inflation. So you can imagine what kind of things would be in there. If we have an inflationary environment, stocks go up generally. But hold on, if there's a real problem in the stock market, we just don't want to be long stocks. What we do want to be long, though, is things that have infrastructure and wealth embedded in them. So again, I always look to the oil industry. There is a lot of infrastructure in the oil industry. The value of pipelines and rigs and outside platforms that exist on the water, all the infrastructure is an asset. Those things have value in an inflationary environment. So obviously the portfolio is going to consist of things like oil components. It's going to consist of commodities, things that also could go up in price under an inflationary environment. So we have a commodity index in there. We have gold in there, of course. So gold will represent something that obviously is an inflation fighting device. We also have a little bit of cryptocurrency in there. Again, it's a decorrelated investment. And if there is a lot of inflation, aside from the fear, there will be a point where someone will have to be forced into alternative assets. So ultimately, to sum it up, it is the idea of the construction of this portfolio is going to be to profit and avoid risk in the event that inflation continues as it is now, or goes higher, or slowly goes lower. So it is recommended for those people that just don't know what the inflationary environment holds. And if should the stock market be a consequence of deep inflation where we have to raise interest rates, obviously it's not going to hold any bonds currently, but it would hold bonds should the bond market go down appreciably. for the higher rates to try to combat it. So there is a component in there to manage that as well. So ultimately, to sum it up, it's an anti-inflationary shield against uncertain times.
Perfect. That name makes sense. And if anyone's interested in investing into it, it is already on the platform right next to all the other additive smartfolios. So in the top right corner, you see the invest button. Click on it, scroll down a little bit, and you can see more about it there. And if you guys are waiting for more information on it, like I said, there will be more coming out from our team here soon. So I think that's it on the new smartfolio. Just checking, and I
I
think we'll
have one
probably
more I could quickly talk about, Lee, if you want.
sure.
Well, we're also looking at a DeFi portfolio. In other words, things that are anti-finance. In other words, things that would represent a change of infrastructure in the way we finance things going forward, a way to be able to manage an uncertain government, sovereign governments managing their affairs. So we're looking at that in a broader perspective, and I expect the idea of that portfolio. I expect to have that portfolio within the coming month or so, and the idea of that portfolio is to say to an investor, I don't know what's going to happen in this world. How do I manage it? It's not about inflation. It's just to manage where I just don't trust certain things about our government and foreign governments to work out their affairs. How do we manage that? And it's not putting your money in a mattress. So we want to come out with new kinds of products and collections of stocks that we call smartfolios that represent a way to manage expectations that we might have going forward.
Perfect. And you just made me think of something else. Like I know back when we created BitFlip, and I'll give my opinion here. I saw a lot of people that moved their money out of, say, balanced or conservative and aggressive into BitFlip and kind of just replaced what they were doing. Not asking for advice. In your opinion, would Shield be something they use in addition to what they're already doing, or would it maybe be more of something that they might want to move more of their capital into, depending on obviously what their thoughts are on the market, the world, etc.?
Correct. I would never advise anybody to put all their eggs in a basket. I think we all know that. I would like to think that we all know that on this kind of a call. But there is a reason to invest in multiple types of portfolios, because if some of the portfolios are even incorrect, it doesn't mean that your concept is wrong. In other words, I don't think inflation is really the problem going forward, but that doesn't mean that the components in there would underperform if you are right. In other words, if you say, hey, I don't think that this is the real problem we have, so I'm not going to invest in it. The idea of the Shield portfolio could be, it's like, you don't have to really be right. If you're right, you'll prosper much greater. But if you're wrong in the market, and we do need to shield our portfolio, we do run into problems, then you're going to definitely be happy with something like this. On the other hand, if you're right and inflation is not the problem, it doesn't mean that the portfolio will underperform,
Right.
underperform vastly or go down. It just means it won't perform as well as, say, buying the Magnificent Seven or just the S&P.
Sure.
So the idea, of course, would be to invest, certain amounts in each portfolio. So if I were to divide by 5 different portfolios, I might have 20% in something like that, and say 20% in just all growth, 20% in conservative. That's the way you manage it.
Perfect.
Call these things motifs.
Awesome. And we probably have maybe 10 or so more minutes on the stream tonight. So if, I've seen a few questions and we'll start covering them right now. But if you haven't gotten your questions in yet, now would be the best time to do so, to make sure that we have time to get to it tonight. So I'll start with the first one. Alan, I'm not sure if you're still here, but he basically said, why are you hiding returns? I don't want to think too much into this, but I'm not sure where you're not seeing them. I will say, just at a high level, there are certain things we can't put on our website. So if you're just looking on there, you might not see as much as you're looking for. So feel free to get with me. We can take this offline. I'm happy to answer any questions that you have. And Kelly, go ahead with your comment.
I want to, yeah, it's a question. Nobody hides returns, but what are returns? Returns are, say Lee and I, we both invest at iFlip, and Lee, of course, comes in January. I come in March. Obviously, we'd like to think that we were both in the market in April. We're going to have the same return if we bought the same Smartfolio. However, the returns can be a little bit different between us, even in a given month, depending on the amount of money we invested into the portfolio. So the more money you invest, the more accurate the returns become, because you get closer and closer to the proper allocations. But if we invested, say, Lee invested $1,000 into a Smartfolio, and I invested $10,000. His $1,000, if the portfolio had 10 things, would mean he'd have to buy $100 of all 10 stocks, which is what we would do if we just allocated evenly. And if we were to do that, some stocks are more than $100. So then I got to buy a part of a stock and a fraction of a stock. Mm-hmm. And then the fractional component is not quite perfect. So that's one thing. And here's another thing about returns in the display of returns. If you go to most websites, go to Fidelity, go to Charles Schwab. I have those accounts as well, because you might have a 401k there that you couldn't have at Flip until very recently. And if you go there, your returns are never, you can't tell me in there where you can say how much your portfolio is up on the year. Yeah. They don't do that. What they do is they tell you how much you are up on your individual positions and where your cash is. We do that too. The reason they don't post returns is this. Say I started with $100,000 and I traded that for 3 months. And then you say, wait a minute. I'm going to take $75,000 out. I need to buy a thing for my daughter. Well, my account for the first 6 months had 100,000. Maybe it was up 5%. So you have 105. Now you take $75,000 out. I have $30,000. Well, but that means I sold some of my stocks. Now I have much less stocks. What's my return now? What is my denominator to base on what my return is? Is it 30,000 or is it 100? If it's 30,000, I could exaggerate my returns. But if it was 100,000, it would be that first 5,000 you made, you could have said you were up 5%. The reason that large institutions, including Flip, don't do that is because of the withdrawals and additions. People take money in and out of their accounts all the time, large sums. Yep. And it affects the denominator, because what is return? It's the profit divided by the value of your initial portfolio. And if you think of it, if your initial portfolio is all of a sudden changed dramatically because of a withdrawal, it makes a difference. Yep. So it's the display of a return should really be only based on the return you have on your individual stocks. And you all know what you put in, and you all know what you have now. That is your return. But you have to also say, I took out $75,000. Now I only have 30. What is my return? Yeah. I asked you that question. The person that asked it, I would respond, Alan, what would be my return under those circumstances? So that is a thing more for offline, but it is a math question. And the way it's addressed globally is the way I just described.
Yeah. I could even take it a step further and correlate it to Boris's question, but we could even give a return on the money that's actually working for you. If you only have 50% of your money invested, then our returns double what they actually are. If you make 10%, but you're only using 50% of your money, technically you've made 20% on the 50% that's working for us. So that's a whole rabbit hole. Didn't mean to make it a
rabbit hole, and that's why, question. Yeah. And we follow the same way that the large institutions do it, because we've learned that there's a reason they do that.
Yeah. I think you already said hi, but Carolyn's in the house, so she said hi, Kelly.
Hey, and Carolyn, I always say hi to my incredible friend Carolyn Borodin.
Thanks for being here. As with
since I was in my 30s, before my 30s.
Sarah also said hello to both of you. I saw Randy in the chat as well. So Hello, Sarah. Thank you for joining. Tom, with our first other question, is it a good time to look at alternatives like real estate? There could be a lot here.
I'm obviously we all. This is actually kind of a fun thing, even though it's off platform for Flip. Flip doesn't do real estate unless you're buying American Tower or something like that, a REIT. Um, I don't know. I think I like real estate because I like the safety of it. I like the idea of asset ownership. It's hard to get away to say, hey, look, I have an asset. You don't really price your house day to day, do we? We know what our house is basically worth, but we're not moving anywhere. But a stock, we look at that kind of much differently than we do a house or real estate. So real estate is obviously a function of interest rates. The reason why pricing in houses is so high is because the interest rates have gone up and there is a shortage of single family homes in America. And there's also a shortage of apartment buildings. So obviously those things are what builders and contractors are building right now. If I was interested in real estate, I would be interested in being a lender. A lender in the first position. Why? Because there's a lot of people out there that are looking for capital. I get emails and spam emails offering me capital all the time. And I obviously don't want it because I know they want 10, 12, 13, 15% on their money. And then if I had a project that I can make 30 or 40% on it and I have to pay 15% on it, maybe I would do that. But the margins are thin for both contractors right now, and also with the high interest rates, it's hard to sell. So real estate, I like it in general. I always want to be a part of it. And actually, just let me bring up something real quick. I think it's noteworthy. This is American Tower. It's a REIT. I mean, this is telling you something about the real estate market. It doesn't look good, does it? That's not a good looking. It looks to me like that's going down, folks. So again, if I'm in the business, I'm not building, I'm lending. I'm a lender here because I'm going to get a high interest rate. And as long as I'm in the first position, and most of you hopefully know what that means, then there is opportunity that way. So real estate, question, I'm on the lending side, first position. Perfect. And I am not an investor in it in the stock market through products like this yet.
Good stuff. Where was I? Sarah just had a comment about when you were talking about inflation and all the other factors that maybe aren't as obvious, I guess, to the average person. The next one, and I'm sorry, I'm not even going to try to butcher your name. I apologize in advance. But the question is, how about silver? Talking about, I believe, back to the Shield Plus portfolio.
Yeah. By the way, let's take a look. I just brought up a silver chart. So here's the silver chart. And by the way, here's the gold chart. So they're kind of similar. Silver is an industrial metal, but it's not the same industrial metal it was when we had Kodak film. It is cheaper. Smaller changes make it more volatile. If I was to be in either of these markets, I would be in the gold market, but that's me because without doing a great deal of research right now of which precious metal is better to own, my instinct, it would be gold. Why? Real quick, silver to me has more industrial uses, and if there's a declining economy, I would not put that in the Shield portfolio, for example, but I would put gold because gold is something that's still portable enough, albeit it's heavy. You don't need as much of it to port it, right? Silver is also heavy, but it's cheap. It's $25 or so an ounce as opposed to gold, which that same ounce is worth 10 times as much. So I can't stay in the silver market. But the gold market still has reasons I could own it. And there's the silver market. obviously it's done well. I mean, it's gone from 22 to 28, but it was as high as 32. Um, by the way, in this area here, it looks like this would be a place I might take a stab at it because of just the patterns, but I just don't know. I can't comment deep enough on it. Real quick, palladium sure doesn't look like that's worth anything. Here's the platinum market. Doesn't look like gold or silver at all. So I don't think people play these markets the same way. So I'm going to decline to answer deeply on silver because, again, I lack the information to offer a reasonable answer.
Sounds good. I really like this question. Not to influence your decision on what's going to be the winner at all, but I think this is very thought provoking. I think it's a great question for everyone who is not as familiar with what we do. So Boris said, "Hey, Kelly and Lee, I have several smart folios and noticed there are unused funds in each of the smart folios. If the concept of the smart folio is to have the AI mitigate my losses, why wouldn't you invest 100%?" The answer is kind of in the question, but Kelly, expand upon this for everyone that doesn't know.
Here's why. So a smart folio, we have let's say our wealth is $100 and we're in one smart folio. Hopefully our wealth is much higher than $100. And the idea here, and say we're following 10 stocks inside that smart folio. Each of those 10 stocks are running on a machine learning and an algorithm that manages the ownership of that stock. We get in and out of the market. Okay, so say one of those 2 or 3 of those 10 stocks that we follow are under sell signals. So we get out of those 3 stocks. Well, if we have an equal weight, that means that 7 stocks are in the market. That means I got $70 in the market and 3 stocks are not in the market because the math says we don't want to own these right now. We think it'll be cheaper and we're going to try to buy it cheaper. That means we got $30 in cash. Well, here's the issue. If I have $30 in cash, I'm really doing 2 things. One, I'm taking away the exposure to the market by saying, hey, I don't trust the market. If the market goes even lower, then my $30 sitting in cash is not going to lose any money. So what we've done is we reduced what we call your beta. Your beta goes to literally 0 if you have no positions on. However, if we're fully invested in all the algorithms and all the machine learning, like all 10 symbols, you'll be 100% invested. So we're always in between 100% invested and 0 invested. And that means that we have all the risk on. In other words, we're 100% invested. And we have sometimes right now, we're kind of around 70%, which means we have some 30% of the money is risk off cash. And it's waiting for the next signal. And by the way, I got to have the cash. When that signal comes, I need cash to buy it. That's why we move in and out of cash. What we're really doing is controlling your beta. And the beta is really just your exposure to the market as a whole. So cash, everyone, and this is something that we all have to understand, is a position. Cash itself is a position. It's the position of you don't trust the market. We think we can do better on something else. So if you have to understand that is a fundamental way investment managers manage the risk of a portfolio. How much cash do you have and how much invested do you have? And it always is generally going to vary between 20 and around 80, maybe 90%. In my career, I really have never seen 90% of my money, or never 100%, all working. Very rarely. Maybe once have I seen that, and that was in the 90s. So we look at cash as a position. Also, one other thing to add to that, it's also important. A lot of times if you look, the idea is to see what happens instead of being 100% invested. Wouldn't you be happier if I could be 70% invested, but still make you as much money against the S&P, for example, because that's our comparison, as if you were 100% invested? That's really right. If I can make $70 work like 100, that's good, because that means you have $30 that's not exposed.
Right.
So this is a question of risk on and risk off. And right now, because of the market, and the reason we do AI Circle is to give you an idea of where risk on and risk off is. That's why I talk about the general market. Right now, we're transitioning from risk on to risk off.
Perfect. Yeah, and you kind of said it, but just to make it clear, with cash being a position, that's our way to hedge, right? In so most people, and why I think this is such a good question is most people are used to just being 100% invested 100% of the time, right? To buy and hold, but then you have all the risk.
Yes. And that's also, I would also argue that that's foolish. I could tell you every fund manager I worked at never was 100% invested. It might have been 70. Now they did use lever, but they didn't use a lot of lever. But they use the lever because if you know you can make $70 work like 100, then why wouldn't I just lever it if I wanted to? Because it's actually much more efficient to do that. Also, keep in mind, because of the nature of flip, broker dealer, etc., we can't go short. Now, in a perfect world, the way I could manage risk for someone that wasn't willing to go to cash would be, okay, we'll hold all the stocks, but I'm going to take a short position in E-minis or the SH. But we can't go short. And that's for a legal reason. Now, individual customers here can go short on our platform by buying something called the SH. Let me show you what that looks like. That is a way for people to hedge. I don't recommend it because you really got to know what you're doing to be short the market. Trust me on that. My friend Carolyn will tell you all about that. So look at this. Here is the SH. Look at this today. I mean, the reason this thing is going down is because the market has gone up. And so I could hedge by buying this and saying, hey, I think the market's going to go down. I'll hedge the portfolio. But should I have done that? Obviously, I'm a loser because it's at all-time low right here today. And that tells you something. It tells you that there's ways to hedge. But in general, especially inside of IRAs or most people's accounts, broker dealers, we can't do that. Investment managers, fiduciaries can, but they almost never will. So there's a huge question around cash versus short positions as well. That's another long tableside conversation.
Awesome. We just got a last question. We'll wrap it up. Deborah asked, how can I learn about the smart folios? So Deborah, inside the platform, there's a invest button on the top right. If you have an account already, then you'll have access to all of this. As I was kind of mentioning when I was discussing Alan's question, there is some information on the website about the smart folios, but by no means do we have everything. So you can set up an account. Again, we won't charge you anything when there's nothing in the account. You can set up the account, get access to all the smart folios, see what's inside each of them, see which ones you like, and see how much you'd like to invest. That would be my short answer. And if we don't have any others, then I'm going to bring this back up. Just as a reminder, and Kelly, feel free to pick from the questions to pick our winner tonight, but there is the $25 Amazon gift card at stake here. The only qualifications that you need is that you have to be an iFlip user and also use a smart folio. And whoever the winner is, just reach out to us at mailbag@iflipinvest.com and we will respond to you with your winnings. So Kelly, you have a winner for us?
Boris is the winner, because it's a most important question is why wouldn't you have, if the idea is to mitigate risk, why wouldn't you have 100% invested? And the answer again was, and that's really the fundamental question, is you move to cash. That's how you mitigate the risk. Cash has no risk other than inflation.
Sure.
And so that's why that question is the most pertinent question.
Awesome. So Boris, and I'll put it up again. I'll just put it at the bottom so we don't cover our faces. Um, uh, so Boris, just send us an email at mailbag@iflipinvest.com. Just either send a screenshot of your account or just give us your account number and we can take a look at it. But I did think that was a great question. I didn't want to influence Kelly on making you our winner, but I thought it was a great one and very thought provoking for those that might not be as used to what we do here because it is different.
It's different.
So awesome. Kelly, any parting thoughts before we let everyone get on with the rest of their day?
Only thought I is the same one I offer every time. Look, everybody, happy health, happy next 2 weeks. I'll see you in 2 weeks. Let's see where the market is. Seems to grind almost nowhere, higher and lower, depending on what you're looking at. All the best, everyone.
Awesome. And just on that note, usually I would announce what our next AI circle is here. I know next week is 4th of July, so it won't be next week. And then the week following, we're actually going to be, or at least I know I'll be in Las Vegas. So we will get some communication out as to when the next one is. It should be in the next couple weeks, though. And until then, have a great rest of your day. Enjoy the 4th of July, and we will see you again soon. Thanks for joining.